Welcome back to Navigating Abundant Retirement. I'm Carol Dewey, and today we're going to talk about something that frustrates almost every high-income professional and business owner I meet: taxes. Let me start with a question. When was the last time your CPA called you? Not to file something late, not to answer your question, but to proactively offer an idea that saved you money. If you're like most people, the answer is never. And that's not because you have a bad CPA. Most CPAs are hardworking, ethical professionals. But here's the truth. The traditional CPA model is reactive, not proactive. They record history, they make sure your numbers add up, and they keep you compliant with the IRS. But they rarely act like strategists. And when you don't have strategy, you overpay. In fact, Forbes reports that 93% of business owners overpay on taxes every single year. That's money you've earned, money you've risked your time and capital to build, simply handed over because no one raised their hand to say, wait, here's a smarter way. Today I'm going to show you how to shift from reactive accounting to proactive tax planning, and why making this shift now in the middle of the year is the single most profitable move you can make for your future. So let's paint a picture. You finish your fiscal year, you send your numbers to your CPA, they crunch, reconcile, and file. Then they tell you what you owe. At that point, the year is over. The ink is dry, and all the opportunities to legally and strategically reduce your liability have vanished. That's what I mean when I say most CPAs record history. They tell you what happened last year, but they don't change what happens next year. Here's the problem. At high income and business ownership levels, that history can cost you 6, even 7 figures over your lifetime. I worked with a client, a successful business owner in the automotive industry, who had faithfully used the same CPA for 20 years. Every year he paid his bill, wrote his tax check, and moved on. When we performed a tax strategy review, we discovered he had been leaving $1.1 million on the table over the previous decade, simply by not structuring income, deductions, and retirement contributions strategically. Another client, a corporate executive, had a similar story. His CPA was sharp, very detail-oriented, but never proactive. When we reviewed his situation, we uncovered tax credits and deductions tied to his business investments that resulted in a $2 million refund. Imagine his face when the IRS sent him a check he never knew was possible. These are not isolated cases. They are the norm. And here's why. CPAs are trained to avoid risk, not create opportunity. Their job is compliance. Our job as forward-thinking advisors is strategy. Think of your tax life like medicine. A CPA is like a pharmacist. They fill your prescription accurately and make sure it's legal, but they don't diagnose, they don't prescribe. A proactive tax strategist is like a physician. We look at your entire situation, run diagnostics, and then design a treatment plan to improve your financial health. The best outcomes happen when you have both, a strategist to prescribe and a CPA to ensure compliance. Unfortunately, most people only have the pharmacist, and that's why they're stuck. When you bring in proactive tax planning, you open doors to strategies like deferring income during high earning years to avoid IRMA surcharges on Medicare, leveraging advanced retirement plans beyond the standard 401k or IRA, using charitable structures like donor advised funds or charitable remainder trusts to offset large gains, timing capital gains realization in sync with estate planning for maximum efficiency, restoring or restructuring your business entity to minimize self-employment tax and maximize deductions. These aren't exotic loopholes. They're right there in the tax code if you know where to look. Here's where many high-income earners and business owners make a mistake. They wait. They tell themselves, I'll worry about tax planning later, after this quarter, after this busy season, after I sell the business. But delay is expensive. Every year you wait, you lock in overpayments that can never be recovered. Unlike a bad investment you can sell or a bad hire you can replace, A tax overpayment is gone forever. Think about it. If you're overpaying $100,000 a year in taxes and you plan to work another 10 years, that's $1 million you will never see again. That's money that could have gone into compounding investments, employee growth, family legacy, or simply buying back some of your own time. We had a client, a physician who owned his own practice, who realized this too late. He had been advised to funnel as much as possible into safe but tax inefficient vehicles. By the time we reviewed his situation, he had paid an extra $600,000 in taxes over his career. While we were able to restructure and save him money going forward, those previous dollars were gone. That's why timing matters. The best time to implement proactive tax planning isn't next year, it's this year and right now. If you're a business owner, the opportunities are even greater. You're not just dealing with W-2 income. You have flexibility in how you take distributions, how you structure your entity, how you compensate yourself, and how you invest back into your business. Yet most business owners are still treated like W-2 employees by their CPAs. Consider this. A dry cleaning franchise owner was commingling business and personal expenses. His CPA shrugged it off. When we intervened, not only did we restructure for tax efficiency, but we also increased his business valuation by $2 million because buyers want clean books. A dental practice owner was preparing to sell and expected to lose 35% to capital gains tax. By introducing a wealth replacement trust and timing that sale strategically, we reduced that hit by nearly half. A Kentucky business owner was planning to transfer ownership to his children. Without proactive planning, estate taxes would have consumed a large portion of the transfer. Through those structures, we preserved nearly all of it for his family. These aren't just tax savings, they're legacy multipliers. This is why I founded Claris Advisory Partners. Claris exists to work alongside business owners and high net worth families who are ready to stop recording history and start creating strategy. Our process is diagnostic, prescriptive, and collaborative. First, we diagnose. We evaluate your current tax and business structure, highlighting missed opportunities. Then we prescribe. We design a custom plan with proven strategies to reduce liability. And then we fill. We coordinate with your CPA to execute legally and efficiently. We don't replace your CPA, we empower them. And the end result? You keep more of what you earn, your business grows in value, and your family legacy strengthens. Let me bring this full circle. The question was, when was the last time your CPA called with an idea to save you money? If your answer is never, it's not your fault. It's the system. But it's your responsibility to change it. Proactive tax planning isn't just a financial tool. It's a competitive advantage. The difference between those who simply pay their taxes and those who strategically plan is measured in millions. And as we've seen, the cost of waiting is the most expensive mistake of all. So whether you're a high-income professional frustrated by your tax bill or a business owner preparing for growth or exit, the time to act is now. I want to thank you for joining today's live session. If you're ready to stop overpaying and start planning, schedule your complimentary lifestyle and legacy assessment with Perpetual Wealth Financial or a discovery session with Claris Advisory Partners. This is Carol Dewey. Stay informed, stay empowered, and remember, we help navigate the financial seas so you can get on with living, and we will see you again